Secure your future. Why invest? Investing is important. It's about growing your money. It helps you achieve your financial goals. Imagine a comfortable retirement or buying a dream home. Investments make those dreams possible. Think of it like planting a seed. You put money in an investment. Over time, it grows. This is thanks to interest or increased value. Investing helps you fight inflation. Inflation makes things more expensive over time. Investments help your money keep up. Don't wait to start investing. Time is your friend. The sooner you begin, the more time your money has to grow. Demystifying investments. What are they and why should you care? Investments are ways to put your money to work. You're buying something that you hope will increase in value. This could be a piece of a company, a loan, or a basket of assets. Why should you care? Because investments help you build wealth. They help you reach your financial goals faster. Saving money is important, but investing is how you make your money work for you. Investing might seem complicated, but it doesn't have to be. With a little knowledge, anyone can learn the basics. Remember, investing is a marathon, not a sprint. It's about making smart choices for long-term growth. Investment ABCs: stocks, bonds, and mutual funds. Explained. Let's break down some common investment types: stocks, bonds, and mutual funds. Stocks represent ownership in a company. When you buy a stock, you own a tiny piece of that business. If the company does well, the value of your stock goes up. Bonds are like loans. You lend money to a company or government. They promise to pay you back with interest. Bonds are generally considered less risky than stocks. Mutual funds pool money from many investors. This money is used to buy a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer instant diversification. Weighing the scales: benefits and risks of each investment type. Each investment type comes with its own set of benefits and risks. Stocks offer the potential for high returns, but they are also considered riskier. The stock market can be volatile. This means prices can go up and down quickly. Bonds offer more stability and income. They are less risky than stocks, but typically offer lower returns. This makes them a good option for investors who are risk-averse. Mutual funds provide diversification. This helps to reduce risk, but they also come with fees. Make sure you understand the fees before investing in a mutual fund. Section 5. Baby steps to big returns. Beginner tips for investing. Ready to start investing but don't know where to begin? You're not alone. Many people feel overwhelmed when they first think about investing. Here are some tips for beginners. Start small. It's important to take baby steps. You don't need a lot of money to begin investing. Even a small amount can grow over time with the right strategy. Start with a small amount and gradually increase your contributions over time. Do your research. Knowledge is power in the world of investing. Before investing in anything, understand what you are investing in. This means looking into the company or asset, its performance history, and future potential. Learn about different investment options and choose those that align with your goals and risk tolerance. Consider your time horizon. If you are investing for a long-term goal, such as retirement, you can afford to take on more risk. This is because you have more time to recover from any potential losses. If you need the money in the short term, you'll want to choose more conservative investments. These are generally safer and less volatile, helping to protect your capital. Section 6. Choosing the right path. Finding your investment style. This is a crucial step in your investment journey. Not all investors are the same. Each person has unique preferences, risk tolerances, and financial goals. It's important to find an investment style that fits your personality and goals. This will help you stay committed and confident in your decisions. Are you comfortable with risk? High-risk investments can offer high rewards but also come with significant volatility. Or do you prefer a more conservative approach? This might mean lower returns, but also less stress and more stability. Your risk tolerance will determine the types of investments that are right for you. Consider your time commitment as well. How much time can you realistically dedicate to managing your investments? Do you want to be actively involved in managing your investments? This can be rewarding but also time-consuming. Or do you prefer a more hands-off approach? Letting a financial advisor handle your investments can free up your time for other pursuits. Your answer will help you determine which investment strategies are a good fit. Aligning your preferences with your investment choices is key. Remember, there's no one-size-fits-all approach to investing. Each strategy should be tailored to your individual needs and circumstances. The key is to find a strategy that you're comfortable with and that aligns with your financial goals. This will help you stay on track and achieve your objectives. Section 7. Building your investment portfolio, a step-by-step guide. Once you've determined your investment style, you can start building your investment portfolio. This is a crucial step in your financial journey. Here's a step-by-step guide to help you navigate this process effectively. 1. Set your financial goals. What do you want to achieve with your investments? Clearly defining your goals is the foundation of a successful investment strategy. Are you planning for retirement, buying a home, funding education? Your goals will shape your investment strategy and guide your decisions. 2. Determine your risk tolerance. How much risk are you comfortable taking on? Understanding your risk tolerance is essential. Your risk tolerance will influence the types of investments you choose, ensuring you can handle market fluctuations. 3. Choose your investments. Select a mix of investments that align with your goals, risk tolerance, and time horizon. Diversification is key. 4. Diversify your portfolio. Don't put all your eggs in one basket. Diversification helps manage risk. Spread your money across different asset classes to reduce risk and increase potential returns. 5. Monitor and adjust. Regularly review your portfolio and make adjustments as needed to stay on track with your goals. This ensures your investments remain aligned with your evolving financial situation. Section 8. The long game. Patience and consistency in investing. Investing is a marathon, not a sprint. It's about making smart choices for long-term growth. Don't get discouraged by short-term fluctuations in the market. Stay focused on your long-term goals. Consistency is key. Invest regularly, even if it's just a small amount. Over time, your contributions will add up and compound growth will work its magic. Remember, investing is a journey. There will be ups and downs along the way, but by staying patient and consistent, you'll be well on your way to achieving your financial goals. Section 9. Taking charge of your financial destiny. Start investing today. Investing is one of the most powerful tools you have for building wealth and achieving your financial dreams. Don't let fear or procrastination hold you back. Start investing today, even if it's just a small amount. Remember, knowledge is power. The more you learn about investing, the more confident you'll become in making investment decisions. Take charge of your financial future and start investing today. You'll be thanking yourself for years to come.